Welcome to our YouTube channel. In this video, we are going to talk about how investing in stocks works. Before starting this video, like this video and subscribe to our channel for future updates. Investing is a way to put money aside while you're busy with other things and have it work for you so that you can reap the full benefits of your labor in the future. Investing is a means of achieving a happier outcome. Warren Buffett, the legendary investor, defines investing as the process of putting money out now in the hope of receiving more money later. The purpose of investing is to put your money into one or more types of investment vehicles in the hopes of increasing its value over time. Let's say you've set aside $1,000 and are ready to dive into the world of investing. Perhaps you only have $10 extra per week and want to start investing. In this video, we'll walk you through the steps of becoming an investor and show you how to maximize your profit while lowering your expenses. Before we get into the video, allow us to mention that nothing mentioned in this video is financial advice and we are not financial advisors. We would recommend you ensure that you conduct a due diligence process before making any decision that may affect your financial portfolio. If you are looking forward to seeking external advice, head out to your trusted financial advisor who has a clear idea of your financial situation. Having said that, let us get into this video. What kind of investor do you think you are? Before you invest your money, you must first determine what type of investor you are. An online broker like Charles Schwab or Fidelity will ask you about your investment goals and the level of risk you're willing to take when you open a brokerage account. Some investors want to manage their money's growth actively, while others prefer to set it and forget it. Stocks, bonds, exchange-traded funds or ETFs, index funds and mutual funds are all available through more traditional online brokers, such as the two mentioned above. Brokers who work online. Brokers might be full-service or low-cost. As the name implies, full-service brokers provide the complete spectrum of traditional brokerage services, including financial consulting for retirement, healthcare, and all things monetary. They normally exclusively work with high net worth individuals and can demand significant fees, such as a percentage of your transactions, a percentage of your assets that they manage, and occasionally a yearly membership fee. At full-service brokerages, minimum account sizes of $25,000 and higher are standard. Traditional brokers, on the other hand, justify their high fees by providing extensive advice tailored to your specific circumstances. Discount brokers were once the exception, but now they are the rule. Many discount online brokers also offer a set-it-and-forget-it Robo Advisory service, which allows you to choose and place your own trades. Online brokers have incorporated more features, such as instructional content on their websites and mobile apps, as the financial services industry has developed in the 21st century. Furthermore, while some cheap brokers have no or extremely low minimum deposit requirements, you may be subject to other restrictions, and accounts without a minimum deposit may be subject to fees. If you're thinking about investing in stocks, this is something you should think about. Robo Advisors. Following the financial crisis of 2008, a new type of investment advisor emerged, the Robo Advisor. Betterment's John Stein and Eli Broverman are widely acknowledged as the pioneers in the field. Their goal was to employ technology to reduce investment expenses and streamline financial advice for investors. Other robo-first companies have sprung up since Betterment's inception, and even major online brokers like Charles Schwab have introduced robo-like advisory services. According to a survey by Charles Schwab, by 2025, 58% of Americans would receive robo-advice in some form. A robo-advisor may be right for you if you want an algorithm to make financial choices for you, including tax loss harvesting and rebalancing. Also, if your goal is to develop long-term wealth, you might perform better with a robo-advisor, as the success of index investing has proven. Employer-sponsored investing. If you're on a limited budget, put 1% of your salary towards your company's retirement plan. The truth is, you're unlikely to notice a contribution that small. Contributions to work-based retirement plans are deducted from your paycheck before taxes are calculated, making the payment even less painful. If you're happy with a 1% contribution, you could gradually increase it when you obtain annual raises. The extra contributions are unlikely to go overlooked. If you have a 401k retirement account at work, You may already be investing in your future with mutual fund allocations and even stock in your own company. Minimum account opening requirements. A minimum deposit is required by many financial organizations. In other words, unless you deposit a specific amount of money, they will not accept your account application. Some companies won't even let you open an account with a deposit of $1,000. Before determining where you want to open an account, do some research. Minimum deposits are listed at the start of each review. Some companies may not have a minimum deposit requirement. Others will frequently reduce costs, such as trading and account management fees, if your balance exceeds a certain threshold. Others may provide you a specific amount of commission-free deals just for signing up. Fees and commissions. There is no such thing as a free lunch, as economists like to say. Despite the fact that many brokers have recently raced to reduce or eliminate trading commissions, and ETFs provide index investing to everyone who can trade with a bare-bones brokerage account, all brokers must make money from their customers in some way. In most circumstances, your broker will charge you a commission every time you purchase or sell a stock. Trading commissions start at $2 per trade and can go up to $10 for some bargain brokers. Some brokers do not charge any trade commissions, but they compensate in other ways. Brokerage services are not provided by any charity organizations. These costs can mount up quickly and have an impact on your profitability depending on how frequently you trade. Stock investing can be expensive if you jump in and out of positions frequently, especially if you just have a limited amount of money to invest. A trade is an order to buy or sell shares in a single firm. If you want to buy 5 different stocks at once, this is considered 5 separate deals, and you'll be paid separately for each one. Let's say you decide to invest $1,000 in the stocks of those 5 companies. To do so, you'll have to pay $50 in trading fees if the amount is $10, which is 5% of your $1,000. After trading expenses, your account will be reduced to $950 if you invested the entire $1,000. This equates to a 5% loss before your investments have even begun to earn. If you sell these 5 stocks, you'll have to pay the trade expenses again, which will be another $50. It would cost you $100 to make the round trip, buying and selling on these 5 stocks, or 10% of your $1,000 initial deposit. You have lost money simply by entering and departing positions if your investments do not generate enough to cover this. Loads on mutual funds. There are other charges involved with this sort of investment. In addition to the trading fee for purchasing a mutual funds are professionally managed pools of investor funds that invest in a certain area of the market, such as large-cap US stocks. When investing in mutual funds, an investor will pay a lot of fees. The management expense ratio, MER, which is charged by the management team each year depending on the number of assets in the fund, is one of the most essential fees to consider. The yearly management expense ratio, MER, varies depending on the type of fund and ranges from 0.05% to 0.7%. However, the larger the MER, the greater the impact on the fund's total performance. When purchasing mutual funds, you may encounter a number of sales costs known as loads. Some are front-end loads, but no-load and back-end load funds are also available. Before you acquire a fund, be sure to understand whether it has a sales load. When opposed to stock commissions, mutual fund fees are really an advantage for new investors. This is due to the fact that the costs are the same regardless of the amount invested. As a result, you can invest as little as $50 or $100 per month in a mutual fund if you meet the minimum account opening requirements. Dollar cost averaging, DCA, is a moniker for this strategy, and it might be a wonderful way to get started investing. Diversify your portfolio and lower your risks. In the world of investing, diversification is thought to be the only free lunch. In a nutshell, diversifying your assets reduces the risk of a single investment's poor performance negatively impacting your overall investment return. It's financial speak for don't put all your eggs in one basket. When it comes to diversification, it will be most difficult to do so with stock investments. The cost of investing in a large number of stocks, as previously stated, may be detrimental to the portfolio. It's nearly impossible to have a well-diversified portfolio with a $1,000 deposit, so be aware that you may only need to invest in 1 or 2 companies at most in the beginning. This will put you at greater risk. This is where the primary advantage of mutual funds or exchange-traded funds, ETFs, becomes apparent. Both types of securities typically contain a large number of stocks and other investments, making them more diversified than a single stock. Even if you were just starting out and have a small amount of money, you can invest. It's more complicated than just picking the right investment, a difficult task in and of itself, and you must be aware of the limitations you face as a new investor. You'll need to do some research to find out what the minimum deposit requirements are, and then compare commissions to those offered by other brokers. It's unlikely that you'll be able to diversify your portfolio while spending a small amount of money on individual stock. You'll also have to decide on a broker with whom you want to open an account. What do you think about this video? Let us know down in the comment section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.